power in this industry. So thank you for being here. You've got to listen to this talk about title insurance and title companies and protecting yourself, because I have personally lost tens of thousands of dollars on real estate transactions because I was in too much of a rush to dot my I's and cross my T's. So you've got to pay attention, listen to Bill, thank him for his time. He's not getting paid to be here. He didn't pay to be here. He's here to help you. So without any further ado, Bill Kramer.
Can you hear me?
Yeah.
They've got a lapel on it, so I don't know if I can hear it or not. Title insurance companies are probably the most boring companies in the world. When I tell people, they say, what do you do? And I say, I'm in the title insurance business. They look at me and they don't want to talk to me. The title insurance companies are places where you go and a lot of different things happen. The first thing that title insurance companies do is they go to their computerized abstract geographical indices that most of them have, and look at the history of your title. If you want to buy a piece of property, you're going to sell a piece of property, and they look back, and we look back about 65, 75 years, and look at the whole history of all the recorded documents that have ever been recorded during that time period, and take a picture of what the title looks like. Look at every deed, look at every easement, look at all the plaques that were filed, and the mortgages that were put on and taken off and released and taken. That's the first step. And from that, we create for the parties to the transaction a picture of that title so they can make a decision about whether they should buy the property or not. And guess what? Especially residential transactions, we give them that document. It's called title commitment, and nobody looks at it. They don't read it. They don't ask any questions. Because they're borrowing money, they're relying on the lender to look at it. And if the lender's going to make a loan, that ought to be good enough for them. That's not always the case, because you've got something that you want to do with this property. All the lender cares about is it worth the loan. They don't care what you're going to do. That doesn't mean the lender doesn't care, but they don't care about what you want. You should read the title report. You should read the title page. And you should ask questions of the title company if you don't understand. Good title companies have lawyers. The public has 30 lawyers working for it to answer questions about time. The next part, that's called the title part. That's where the word title company comes from. The next part is called the escrow part, or the closing part. That's where you go to sign your documents, sign your papers, pay your money, where your lender comes to loan you the money and give you the loan check or the loan wire, and where the papers are signed and the title is transferred and the title company records all of that. It's called the escrow or the closing process. That's where taxes are prorated, and that's where the insurance is created, and where your deed into your property forges another link in the title chain that goes back to 1845. In South Texas, it goes back to 1836. So the idea of a title company is where lots of things happen, lots of things are investigated. And there are hundreds of title companies everywhere. Trying to judge which one you should select is often difficult, because if you're a homeowner and you're buying a house, the real estate agent will most likely select a title company for you. That's okay, because real estate agents close all the time. They know who's efficient and who they can trust. But you should have some input into it. I was asked to come here to talk somewhat about a company called Millennium Title that has gone busted. We don't know really what happened completely at Millennium Title, but the first thing I have to tell you is it was a brand new title company. It hadn't been in existence a year. but earnest money has disappeared. Lenders' checks have not been paid. The first instance I had on the millennium is I got a phone call from an attorney who's been a friend of mine for 30 years, and he said, close the deal over there. We paid $1.2 million for 2 pieces of property. It's been 2 months. We got no deed. We checked. The seller has gotten no sales proceeds, and the lender has not gotten paid off. It's been 2 months. He said, what do you know? I said, well, let me check it out. So I have brought, if anybody has problems with millennium, pieces of paper and where you can go. Because when title companies go broke like this, the state of Texas, through the Department of Insurance, has created a commission called Guaranteed Assessment Recoupment Commission. And when title companies go busted, all of the title companies, and these are title underwriters in Texas, kick in pro rata based on how much lead business they've done in the previous year, how much money it takes to try and make people as whole as they can make them with respect to these situations like I just described. Another millennium title deal that we are dealing with now is a condominium termination contract. And it was over there was $50,000 of earnest money up, and they moved the transaction to us, to Republic, and I said, when are we going to get the earnest money and transfer the contract? And the earnest money check came a little bit late, but it came from the state of Texas. It came from the Guaranteed Assessment Recoupment Board. And they funded that earnest money and found it. Now, the millennium title is in a receivership, supervised by the state of Texas. Their title policies will be honored by the other underwriters in Texas, and their escrow accounts and other items that where money is missing will be supervised and ultimately paid, if not in full, but partially by the state of Texas, or through the Recoupment Commission. I haven't seen anything like this in a long time. And usually in good times, you will see a lot of people flocking to businesses, like the title business. And I would say in Dallas County, Collin County, Tarrant, and Denton, there's probably 300 title agencies, maybe more. There are 650 to 700 in the state of Texas, and there's a lot just right here in North Texas. So, check out, and it's easy to check out. There's a phone number that we have. You can call the Department of Insurance and say, how long has this title company been in existence? When were they born? They have complaint sections. They have sections where you can look and see whether a title company has had complaints filed against it. It's not easy to, it's easy to find, and it's easy to review it. So, ask people, talk to people. There are many, many good title companies. There are many more good ones than bad ones. Millennium is something that's an aberration, but it's painful to people who are talking. And with that, if anybody's got a question about title insurance or real estate, I'm an attorney. I can maybe help you. So, anybody got a claim in Millennium? Anyone in this group? You do? Where's, when you bring them, get into those boxes, there's a lady here that needs some information. We'll give you this information. It's got all the places you can call, it's got a claim form, it's got everything. The real estate business in Dallas has really been good. It was bad starting in the beginning of 2009, but when the stock market crashed in 2008, you remember that was November, and up until then, the title insurance business and the real estate business was booming in 2008. And then it went flat in the last quarter, everything stopped, title orders stopped, and we went into 2009 as flat as a pancake, and 2009 was a bad year for real estate. But the stock market recovered and the real estate market rebounded, especially in Texas, and it has been an ever-increasing market to levels that I have never seen in the title insurance business before in Dallas. course, Dallas has gotten bigger. When I started in 1965 in Plano, Texas, there's a little title company called Plano Title. There were 14,000 people living in Plano at the time. We were in a good spot. Plano really was a hot place and a good market. So since 65 till now, I've never seen the intensity of this real estate market. I thought it would cool off in 15. I was wrong. I thought 14 was our best year, 15 was a better year, 16 is ahead of 15. But we are noticing now in the commercial section of our business that the commercial transaction orders have tapered off. So we're kind of flattened on the number of commercial transactions coming in to the title company every day. It's kind of flat. But the deals are still closing, and though it's flattening, it's at a very, very high level. Before we were just going up, that's kind of flattened out, but it's still way up there if you're going down it. On the residential side, if you're looking at the residential market, the real problem there is product. There's not really much product out there to buy. And so that market has actually declined. It had declined because of any lack of enthusiasm on the part of buyers. People want to buy houses, and there are more people coming, and they want to buy houses, but there's just not enough houses on the market to satisfy the demand. So this is a market that is flattening out because of lack of product, not lack of demand. If you look at what's going to happen in North Texas and in Plano and in Richardson, and with some of the other moves that are coming that haven't even been announced, there are thousands of people coming to Dallas and all need to buy real estate, or buy houses, or rent property, or rent apartments, things like that. I'm not saying it's never going to be over, because in real estate, there's always a bust. You just don't know when it's going to happen. And you don't know how severe it's going to be or how fast the recovery will be, but it is a cyclical industry, and it goes up and it goes down. You want to do one thing. You want to buy low, and then what do you want to do? Sell out. Right now it's a little tough because you can sell high and you can buy high. So if you sell something for a big profit and you want to reinvest your money, we do a 1031 business. We do a lot of tax-deferred exchanges. I mean, a lot of the people who sold high and had big capital gains, they're having a hard time finding a replacement property that has got a good yield and a good return on it. The real estate has got a better return than the banks have. Money markets and treasuries and those kind of investments aren't paying hardly anything, and real estate is still paying a decent return. But it's a harder investment to manage it. You don't own it yourself. You've got to take care of it. You've got to manage it. Yes, ma'am.
Can you talk a little bit about what the artificial manipulation of the market by the federal government and the other entities you might talk about has, currently is, and what you think it will affect the market?
Well, the Federal Reserve Bank is one manipulation of interest rates, because interest rates have been kept low by the Federal Reserve now for many years. It's longer than I've ever seen. And many of us, if you're old enough, have hoped, we always thought cash was the savior for us. You would work hard, invest, and then cash out, and then interest would support you. You could get interest rates. I can remember interest rates not that long ago at 4.5%, 5% of the savings accounts and money markets. So unheard of that. So that manipulation has fueled the real estate market because interest rates are so low. The stock market is scary. So people who have cash, where am I going to put my cash to get a return? If they were counting on CDs and supposedly more safe investments, they don't pay anymore. So where are they going? They're going to real estate. You're making real estate investments. Look at this room. I mean, you guys are all looking for yield somewhere, somehow, with respect to the excess cash you have. Some of you may think you can work the stock market, and some of you may be able to work the stock market. But frankly, the real estate market is manipulated by the fact that interest rates are so low. So that's one of the reasons. Another manipulation of the residential earnest market. And I don't mean it's a bad manipulation, but this affects demand and supply, has to do with what we call the GECs, Fannie Mae and Freddie Mac, who went broke in the big disaster of 2008. I mean, just went completely broke and were bailed out by the government. Now they're back and making money again. And they were the buyers of most of the mortgages. That's where all the home mortgages go. And HUD buys a lot and originates a lot of mortgages. And what we have seen, like we saw in the lead up of 2004, 5, 6, and 7, before the crash in 2008, was that we saw lending programs that come out of the government entities getting looser and looser and easier, which was an invitation to the mortgage companies and the originators of mortgages who would originate loans and the government would buy them or guarantee them. There really was no private market for this. The government bought it all. And then when everything crashed, those entities went down with the crash because they had so much bad debt. I'll give you an example of what we saw as we closed deals. We would see a financing program that would require 10% down, which was a little different than the traditional 20% down. It was 10% down. You had to have a certain type of income. They verified your bank accounts, your income, everything, and they would look at your debt structure, and they would say, well, with the mortgage payment that you want and with the debt that you have, they would say you don't have enough money to borrow this amount, and they would knock you down, but they'd knock your mortgage down a little bit. Those programs went from 10% down to 5% down to 3% down to nothing down. And at the end, there was no verification. We had a loan program that we were closing, and we were happy to close it because it generated title premiums, but at the same time, it made you wonder, in which there was no income verification. You didn't have to have a job. There's nothing there. It's a great program.
So this probably early 2000s?
What?
Foreclosure. In the early 2000s?
No, that was around 2007, 6, 7. It just was you remember the politicians being enthusiastic about home ownership, and the percentage of home ownership during that period of time reached the highest level in the history of the United States. And that's a good thing. Folks want people to own homes. But if you don't have anything in your house, you don't own anything. And so and then we just had this collapse. People lost their jobs because they had their mortgages. The other thing that happened in Texas, if you're a Texan, you may remember the time when you could not borrow any money against your house except for 3 things. The Texas Constitution said you could borrow money against your house to buy it. You could borrow money against your house to fix it up, to repair it. And you can borrow money against your house to pay it more taxes, say your house would be foreclosed for taxes. Nothing else. Any other type of loan against your homestead was invalid and void. And then other states had home equity laws. Texas finally passed a constitutional amendment about 10 or 11, 12 years ago. It has not been that long, in which we had home equity financing where you could borrow money and take some equity out of your home. Very restrictive. The legislature was schizophrenic about home equity. They wanted people to do it, but they wanted to make it so hard that they didn't want to do it. So the home equity regulations and regulations with respect to borrowing money against your house in Texas are tough. And unlike the other states, you can borrow beyond 80% of your appraised value of your house. In other states, you can borrow more than that. You can't pay more than 3% in closing costs. Other states permit more than that. And there is no personal liability on a home equity loan in Texas. person who borrows the money is not liable. Those are a few of the special provisions of our Texas Constitution on home equity. So folks started borrowing money on their house. Now, it was suggested that you could borrow some of your home equity out of your house to invest it in something else. That's not bad. That means you got a lot of equity because you cannot borrow that last 20%. You can only borrow up to 80% of your total mortgage. So if you got a first mortgage, it's got to be around 40 to 50% for you to borrow enough to get some money to invest. Home equity mortgages are great because you can use them to pay off credit card debt. A lot of people did that because the low interest rate environment that we have now and the high interest rate environment on credit card debt, if you can do that and be disciplined, then you will lower your monthly payments. Just don't build your credit card debt again, because then you got more mortgage to pay and you got more credit card debt to get back into that trap. But home equity lending also fuel that, but mostly in other states, not in Texas. Texas didn't have that kind of problem. I remember watching a 60 Minutes program talking to a lady who was going to lose her home because she had borrowed the home equity out and couldn't pay it back. And she said she had been deceived because they told her the interest rate was such and such. And I was thinking, I wonder what really happened there. And finally, the interviewer said, well, how many home equity loans have you done? And she said, well, this was my fourth. Because her value of her home kept going up, but every time it went up, she borrowed more money. And he said, well, how much did you get? Told her, she said, well, all in all, I got $80,000. She had no equity left in her home at all. She couldn't make the payments. It was an adjustable rate mortgage that, kicked up on her. The payments got her. But the thing was, something else got her, which was that free money, which it looked like it was free. You got to have discipline in real estate, whether it's for your own personal use, for your home, or whether or not it's for investment. You got to buy it as cheap as you can, and you need to borrow as little money as you can, because debt is the killer when it comes to real estate.
All right. Do we have any questions back here? Yes, sir.
Back to the subject of escrow money. When I hand you a check, I'm curious to know what actually happens. Does it go into your bank account? Does it go into a...
It goes to an account in Guatemala. Let me tell you what happens to your escrow money. Let me get it to you as quickly as I can. Escrow money is kept in a special trust account. The Department of Insurance requires that all of those escrow accounts be segregated so that you get maximum of $250,000 insurance on every one we have, even though if they're all in the same bank. Because they're assigned a special number. It is like your personal account. It doesn't go anywhere near the title company's operating account. Every day we have to reconcile the escrow accounts. The money that comes in, the money that goes out. In addition to that, every year they all must be audited by an independent auditor, and that audit must be sent to the state. Any discrepancies in the escrow account are noted by the auditor, and in the set of what we call interrogatories that the state asks every year, you have to answer. You had better keep that thing whistle clean when you title with that. But in between the audits and in between that, title companies are audited by the state, independently of the audit that you give them. Your underwriter, your title agent, audits you as well. So we literally have audits going on not 24 hours a day, but 12 months of the year. There's an auditor in our auditor room that we set aside for them auditing the escrow accounts.
And so can I say, give me my account number and I can go verify that it exists somewhere, or?
If you wanted to know where your escrow account is, you just ask your closer, what bank did you put it in? And you will get your number. It's called a GF number that tracks your escrow account. It tracks your whole file. And you can ask them this question too, and I don't know if you read your commitments, but if you read the commitments that come out, at the end on Schedule C, you will see a long talk about escrow accounts. It's so boring, nobody reads it, but if you read it, it's kind of interesting. What it says is, and the Republic doesn't do this, but the others do. It says, if you want some interest on the escrow account, we will invest it for you under your taxpayer identification number. But because of this low interest rate environment, we will charge you a fee to do all this. And then it goes and tells you that if you've got a typical escrow on a house deal, it's like $2,500, $1,000. You know, you're going to earn 10 basis points on that on an annual basis, and you're going to get charged 50, and nobody does it. Then it goes on to say, now if you don't ask us to do this, remember you're not reading it. If you don't ask us to do this, we'll sweep all of it into an account for us, and we'll put it back. They'll earn it. So in a sense, you give them permission. A big title company will have average collected balances, this is money, coming in and going out of these escrow accounts in the hundreds of millions of dollars. Now, in a low interest rate environment, that doesn't mean much, but in a higher interest rate environment, title companies are loved by banks because there's no demand, there's a demand deposit account, there's no interest paid, they can use that money to sell it to the Fed if Fed fund rates were higher and earn the Fed fund rate. So that's a little thing on escrow accounts.
Now, this Millennium one is the 1 million was in some type of special tax-free account or something. You know anything about it? They said it was covered by the insurance board.
Well, you're covered up to $250,000. And if you want special coverage beyond that, there are ways to do that with repossession agreements, repos, but it's still not a perfect coverage. We buy repos for that. Yes, sir.
Going back to 2009 with flat, I want to know what happened to the developers, the time before that, the developers overbuilt, and the short of the property, I want to know what happened.
Well, the developers that lose their properties in foreclosure, that Mr. Roddy keeps track of. You can look at lot foreclosures. The biggest time that he'll tell you, and we all do, was when the RTC in the 80s was foreclosing hundreds, thousands of lots everywhere. Developed lots. You could buy them in bulk. You couldn't buy them individually. So, yes, that stuff, it's called creative destruction. It's really what keeps the market. It's like to crash and burn, and then you come up out of the ashes, but you need to crash and burn to come back. It's when you don't crash and burn and you just have a slow death, is what we're trying to do.
Yes, ma'am. Did you have a question?
Well, I just have a question going back to your title search. What happens if you find a property that has a lien that's been attached to the property, and that company that put that lien is no longer
In business?
business?
So the question was, if you go to title search, if there's a lien and you can't get anyone on the phone, you can't find them to actually get a release from them,
Yes, what happens then?
what happens, Mr. Kramer?
Well, what we do is we find out whether the lien was paid. We ask the people who own the property, did you pay on this mortgage? Well, no, it was paid off. We knew it was paid off. Sometimes we'll find another title company who's insured over it. That's the thing in Texas is a problem. A lot of liens are not released that have been paid off because the release process is not handled well, and there's no law in Texas that makes a lender give you a release if they refuse. So there are other states that do require it. So yes, you can get insurance over that. There's all kinds of techniques for us to give you a good title. If you've got an old mortgage that's just sitting there unreleased in the public record. Or we'll go find the people. We've got some people that are great genealogists that we go find.
All right, we've got 4 more minutes. Anybody else have any questions? I've got some questions I want to ask Mr. Kramer, but I want to make sure you guys don't have questions.
All right, so Mr. Kramer, you're speaking.
You can certainly on the bill.
Okay, Bill, we've got a group of investors. At the end of the day, we're kind of simple-minded people sometimes, but if I brought you guys a contract, it's a cash deal, what can most of us expect a turnaround time for title insurance? I mean, with 7 days, with 5 days, with 2 days? I'm kind of putting you on the spot, but I
It's not
apologize.
been on the spot. We have a lot of abstractors and examiners. Our standard turnaround time for residential is 3 to 5 days. We can turn around in 20 hours or 5 hours or 2 hours if there's a real reason for it. Because if you just do it all the time, everybody's got a reason to want it faster. But we've had some situations where people were dying, where we had stuff where we needed to get things done real quick, and we can do it and put it at the top of the list literally in a day. On a commercial transaction, our turnaround times are set 7 to 10 days. But if you guys read about the Wagner Ranch, which is a 550,000 acre property, you're not going to get that many 7 to 10 days. But we can do most commercial transactions in the Metroplex in 7 to 10 days.
What's the biggest holdup? You know, from your escrow officers, from your side of the, what's the biggest thing that holds up a closing in a transaction?
Getting the loan documents.
Okay. But if it's a cash transaction,
If it's a cash transaction, nothing should hold it up. It should move as quickly as you can get the title done. And sometimes if the title needs some curative work, we would have to do the curative work. We do cure titles for people. We find that old debt and make sure it's gone. Or find an old easement, or look at restrictions that have died and work things out like that. But it could go as quickly as you want it to go.
talk about the actual title policy. There's, 3 parts, Schedule A, B, and C. B is where you list all the encumbrances that need to be settled up. C is endorsements, or is that just fine print, and A is endorsements?
You're talking about the title commitment.
The title commitment, excuse me.
The title commitment is free. There's no charge. You bring a real deal to the title company, they get you the title commitment, and the deal falls through. There is no charge. The state says you can't charge for that. So if you're getting charged for deals that blow up, and you've got the title commitment, they say, well, I did all this work for you, they shouldn't be doing that. That is not permitted by statute. The other thing is, though, the title commitment has got 4 parts to it. A says who owns what. That tells you who owns it. That's where the record title is, and that hopefully is the same person under contract. B tells you what's against it. In other words, there's this debt, there's this easement, there's these restricted covenants. That's what B tells you. C tells you what the title company needs to get the title in shape to close. It's called the requirements section. You can ask the title company to do those things, or you can do them with it, or your lawyer can do it, but C is where the requirements come. D is the last one, and that's what people don't look at D. That tells you where the title premium's going. Who's getting a part of the premium? Who's getting paid out of the premium?
I think we know who's getting paid.
Huh? Well, that's the thing is, if it's done right, you may find that the seller or the attorney for the seller is getting part of the title payment, or the attorney for the purchaser is getting part of the title payment.
So D is basically
It's
where the money is
sourced.
sourced.
B tells you who's involved in the transaction on the title side. True disclosure. Sometimes they don't even bother to fill it out, but you're supposed to fill it out.
Do you guys have any other questions? I think I'm about out. Yes, sir. One more question, second row, and I'll get you washed up.
Okay, all right.
Real quick.
Thank you, George. So is there any relief for an investor who is buying an investment property? He's paying for the title insurance.
He's buying, he's paying.
The buyer's paying for the title insurance, makes the house beautiful, sells it in 6 months, and is now looking at paying for title insurance again as the seller, the end user. Is there any relief for that individual who's looking at paying for title policies twice?
Yeah, sure. No, there is none. We don't have many credits for owner policies. Frankly, though, it's unusual in Texas. for the buyer to pay for the title policy.
Okay, thank you, Phil.
Yes, sir, Chanel.
In reference to the lender holdup of documents, and I agree with you on that, and I have a couple of questions. First off,
You
as
got
a
one.
buyer, well, it's all part of the question. As a buyer, can a buyer write into their agreement or their attorney into the agreement, even though the lender's not a party to the contract, some kind of a restriction that they must have the loan documents in the title company like 72 hours prior to closing? And if not, and then secondly, can a broker write that into a contract?
Well, you know, the new TRIB regulation, we call them TRIB, is the closing statements, and the new Consumer Financial Protection Bureau stuff requires that there be full disclosure of at least the closing costs and everything at least 3 days before the closing. I don't think they're getting the documents out 2 days before the closing. They're getting the disclosures out 3 days before the closing. So you'll know exactly what it's going to cost you to close.
So they're not drawing documents. They don't draw the docs, just the,
No, that's what I mean, you don't draw the docs, the doc prep is something else, and getting doc prep and writing that in there, I suppose you could write it, but it's not a good, I don't think it's a wise thing to do.
But legally, is the buyer allowed to, or is the attorney allowed to, or is a broker allowed to?
Broker's not allowed to put a clause like that in the contract. Under the broker-lawyer accords, that's practicing law.
Okay, and what about the buyer or the buyer's attorney?
They can do that.
All right, guys, put your hands together.